It is especially relevant as we face our current economic challenges. Dennis Gartman is the editor and publisher of the Gartman Letter and has had extensive involvement in the capital markets since 1974. He received his Bachelor of Arts from the University of Akron and was engaged in graduate study right here at NC State in the early 70s. His career history has provided him with considerable knowledge of the markets, beginning with his work as an economist for Cotton Incorporated, and then as a trader at North Carolina National Bank, where he worked with foreign exchange and money market instruments. He was chief financial futures analyst for A.G. Becker Company in Chicago and an independent member of the Chicago Board of Trade, trading in treasury bonds, treasury notes, and Government National Mortgage Association futures contracts until 1984. Mr. Gartman also managed the futures brokerage operation of Sovereign Bank. He began publishing the Gartman Letter in 1987, a daily newsletter offering insight to many of the leading banks, brokerage firms, mutual funds, hedge funds, energy trading companies, and grain trading companies. He has taught classes at the Federal Reserve Bank's School for Bank Examiners and served a 2-year term as an outside director for the Kansas City Board of Trade. He appears on CNBC, Report on Business TV, and Bloomberg Television discussing commodities and capital markets. We're also pleased that Dennis serves on NC State University's Investment Committee. This evening, Mr. Gartman's presentation is titled The Global Financial Meltdown, Strategies to Stay Afloat, and we'll focus on the credit freeze, the global impact of instability in the economy's banking sector, and what investors can and should do in the coming weeks and months. Ladies and gentlemen, please, a warm Wolfpack welcome for Dennis Gartman. And welcome back.
It's good to be here. I always tell every group that I speak in front of, be careful about applauding for a speaker before you've heard him. You may regret it by the time he's finished. My name is Dennis Gartman, and I'm a trader. I would go back to undergraduate school for career day at the University of Akron. And back in the days, 15 years ago, I would go back and they would say, that's very cool that you're a trader. Can you make much money selling America's secrets to other people? And I would have to tell them, no, it's T-R-A-D-E-R, not T-R-A-I-T-O-R. And there have been times in the course of the last 35 years that I'm convinced that the former is a far better environment and a far better working experience. I have been one of those people down on the floor at the Chicago Board of Trade. They call it the pits for a very good reason. It is one of the worst places one can imagine ever having to work. I don't know why they call it a seat. You never get to sit down. You buy a seat to go down there. Like so many of us back in the late 1970s and early 80s, I lied to Harris Bank so that I could borrow enough money, and basically Harris Bank would lend you money on the seat because it was rising faster than you could probably lose money down on the trading floor. Went down there, maxed out my credit cards, and went to the floor. The fellow who stood to the right of me in the pit, Brian O'Doherty, actually played defensive tackle for our beloved NC State back in the 1970s. Brian was 6'9", 285. He basically caved in the right side of my ribs by yelling and screaming all day. The fellow who stood to the left of me in the pit was larger than was Brian. He basically black and blued the left side of my ribs by yelling and screaming all day. And the fellow who stood behind me, John Ott, was a spitter. Relatively difficult place to go down and try to make a living. I'll show you now the class that they gave us when you bought your seat. This is buy, this is sell, good luck. That was basically it. Went down there, got rich 3 times, got broke 2.5 times, loved it in both directions, lost my first wife to a margin call, those things happen. And I want to talk a little bit about what I've learned about trading and investing, and then we'll talk about what's going on in the economy. What have I learned in 35 years of doing this? Because I trade for my own account. I'm active in the markets on a very daily basis. I'm glued to a trading screen all day long. I've learned not many things, to be blunt. I've learned that Lord Keynes, Marxist though he was, said a couple of very bright things. Keynes said that the markets can remain irrational far longer than you or I can remain solvent. And Gartman's corollary to that is that the markets will return to rationality the moment you have been rendered insolvent. It's a harsh truth, but it's absolutely the truth. And what I find amusing about markets and why I find Keynes to be so bright in that statement is that most of us are taught that the markets are rational. That's hogwash. And if I have to go back, when I like to tell the story, if I could redo my education, if I had to go back, and when I go back to undergraduate school and they ask me, what should you study? What would be the best background to be a trader, to be an investor? And invariably somebody will say, well, should I get my degree in accounting? And I will have to tell them that my lovely bride of the last 20 years is an accountant, and she actually believes that 1 + 2 = 3, unless you're talking to the IRS and you need it to equal something else. But accountants believe in rationality. And I'm sorry, on the exchange floor, rationality doesn't work as Lord Keynes tells us. So you've lost half your audience when you say, no, accounting doesn't work, and people start leaving. Then somebody says, well, should I get a degree in economics? And I tell them, oh, please, no. Because they actually do believe that the markets are rational, and they have these wonderful, infinitely cosmic examples and pages filled with sigmas and deltas, and they believe that they can model this thing. And I never saw an economist come to the trading floor and survive for any protracted period of time. So no, that's not a good background. Now you're losing another third of your audience. Somebody says, should I get an MBA? And I tell them, well, your parents will admire you for that, and they'll think good thoughts. But no, I never saw many MBAs down on the trading floor who did very well, because they really think that if they analyze how circumstances prevail, if they look at the economic fundamentals of some company, if they try to understand what the Federal Reserve Bank is doing, that they'll have a leg up. And I'm sorry, you don't. Now you're down to 25% of your beginning group. And somebody says, well, what would you study? What's the best background? And I tell them, if I had to do it again, I'd study more literature. Because markets are the sum total of the human condition. We are human beings making rational and irrational decisions, bombarded by irrational and rational circumstances at the most inopportune and opportune times, and to try to make sense and rationality of that circumstance is difficult. And literature at least gives you some background to deal with the complexity and the confusion of the human condition. So I tell people, study more literature. I mean, why did Lear split his kingdom into 3 parts? What kind of a trade was that? How would Lear, or how would Hamlet, waiting and trying to get more information and trying to discern whether it really was in fact his stepfather who killed his father, and when he finally found out, still couldn't act. What kind of a traitor would Hamlet have been? So literature is an excellent background. I tell people, if I had to do it again, I'd take more psychology, because that is what the market is. It's the sum total of the psychology and the wisdom and the stupidity of everybody who deals in it. So I would take more psychology. I tell them I would take a lot more philosophy, because that is the study of the human condition. And quite honestly, the folks that have survived, the people who are still here with me, who started trading 35 years ago and are still around with me, are philosophers. But at any one time, the background that seemed to have the most advantage on the trading floor was religion. Because at any one time, there'd be 50 people saying, oh, Lord, just let this thing come back, and I will never do that again. But we are sinners in the hands of a very angry God with a demonstrably larger margin account than yours or mine can ever be. And so maybe that one doesn't work. But I've learned that, yeah, Keynes was a smart man. The markets are irrational far longer than you or I can remain solvent. Keynes also made a wonderful statement. Every year, Keynes would have a meeting at his college in the UK, and he would come up with an investment idea, and people would come to his meeting, the Millennium speech of every year. People would come to listen to Lord Keynes, and he would take one company, and he would talk about that one company. And one year, he talked about this company, and the next year, and he's buying it. And the next year he comes back, and now he's selling that company short. For those of you who don't trade, you can make money by selling things you don't own. You can sell a company short and expect its stock to decline in value. And Lord Keynes is now telling people to sell this stock that only a year ago he was buying. Now he's telling them to sell it short. And somebody stood up and said, Lord Keynes, how can you do this? How can you tell us 1 year to buy something, and now you're telling us to sell the exact same company? And Lord Keynes said, sir, the facts have changed. And when the facts change, I change. What do you do, sir? The business of trading and the business of investing is understanding when the facts have changed. So Keynes was a very bright man. I disagree with him completely philosophically. I disagree with him completely economically. But I agree with him on the statement that the markets can remain irrational far longer than you or I can remain solvent. And I agree with him on the notion that when the facts change, I change. I've learned in 35 years that complexity breeds confusion. That's a hard thing to understand. We are here at a university where we want to believe that the world is complex, where we want to think that if we just get enough education, that we can take all this data and turn it into something that functions well. And I have not seen in 35 years of doing this that the complex, that the truly erudite, that the engines of modeling work. The greatest example of failure was long-term capital management. I love the story of long-term capital management. Here were 3 Nobel laureates in economics. 3 of them, Nobel laureates in economics. And 5 other people who, if they hadn't worked for long-term capital management, probably would have been Nobel laureates in economics. And they were convinced of their wisdom. And they would put a trade on. And the market would tell them that they were wrong. And how does the market tell you that you're wrong? The market is very clear when it tells you that you're wrong. You're losing money. It's that simple. Most people never grab that fact. But the market would tell long-term capital management that they were wrong because the trade would turn against them. And the 3 Nobel laureates and the 5 other people who would eventually become Nobel laureates, if they hadn't worked for long-term capital management, would hold meetings and say, what shall we do? And they would say, well, we are 3 Nobel laureates. We understand the complexity of economic circumstances. Clearly, everybody else does not. Clearly, they must be wrong. Clearly, we must be right. Let us do more. So they would do more of the trade, and it would go against them. And what would they do? They would say, we understand the economics of the circumstance. We understand the complexity of this trade. No one else understands the complexity of it. And we are, after all, 3 Nobel laureates in economics and 5 people who should become Nobel laureates in economics. Clearly, we must know more. Let's do more. Let's average down. And they would. And it would go against them. And they would do more. And they would hold committee meetings, understanding the complexity of the circumstance and eventually taking the capital structure of the United States, almost taking the capital structure of the world, and taking it to an edge of a cliff and almost taking us over to the point where they collapsed. Now here were brilliant thinkers, truly erudite, wonderful, conceptual thinkers about all things economic. And they failed utterly and completely because they misunderstood the one most important rule of all trading. Why do you do more of something that is not working? It doesn't make any sense to me. It is absolutely, utterly senseless to me. If you learn nothing else about the world of investment from me tonight, learn this. If you buy something at 40 and it goes to 35, you're wrong. It's that simple. If you buy something at 40 and it goes to 35, you're wrong. But most people say, well, if it was a good buy at 40 and now it's at 35, it must be a better buy here, and they buy more of it. And then when it goes to 30, they buy more. And at 25, they buy more. At 20, they buy more. At 15, they buy more. At 10, they buy more. And finally, they get to that point. I think it's on page 126 of your Economics 101 textbook, your Paul Samuelson textbook. It's the puke point, the place at which you throw up all over yourself. Most investors get there. Long-term capital management in its complexity, in its erudite understanding of all things economic, almost took Western civilization over the edge in a collapse. I just went to the University of Akron. I just went to North Carolina State. I just understand that this is really not that difficult. That you try to buy things that are going in this direction. Write that down. Okay? Write that down. You try to avoid things that are going in this direction. Write that down. And more importantly, when you do buy something that's moving in this direction, admit that you're wrong and get out. Most investors can't do that. I've learned that being early almost certainly breeds disaster. I was very lucky early in my career working for one of the banks. I got to sit next to the most brilliant economist I've run across in all the 35 years I've been doing this. We'll call her Judy. Judy understood more about Federal Reserve policy. She understood more about the ebb and flow of economic circumstances. She understood money and banking better than anybody I've run across then or since. And you know what was interesting? It was shocking how much money Judy was capable of losing for the bank we worked for. It was mind-numbing, to the point where senior bank management would have to come and tap her on the shoulder and say, Judy, that's enough now. We can't take any more. And I watched this for several years as I sat in the desk, just 3 or 4 seats down from her. And I watched her do this time and time and time again. And what was very sad was that when Judy was finally taken out of her trades, when senior bank management would have to come and tap her on her shoulder and say, Judy, that's enough now, and she would be taken out. Usually it was not much more than 2 weeks. Sometimes it was as few as 2 days. Every once in a while, it was the market was so egregiously nasty that it was 2 hours after she got taken out that it would start to do exactly what she said it was going to do. And yet she was never there. She never made a penny. And I watched her do this time and time and time again. She was always early. Why would you step in front of freight trains and do something that is wrong? Judy taught me that the thing to do with being an investor is understand the 2 or 3 or 4. I just went to the University of Akron. I just went to NC State. I didn't go to Harvard. I didn't go to Yale, where they think wonderful, brilliant thoughts. Okay? I don't have that capability. I can only put my arms around 3 or 4 or 5 economic fundamentals that make reasonable sense to me, common sense to me. I want to understand why something should be going up. If I'm bullish on something, I want to have 4 or 5 economic reasons why it should be going up. And then more importantly, I want to make sure it's already going up. I want to make sure I have the wind at my back. I've watched the great investors over these 3 decades of doing this, and that's what they all do. And when they buy something at 25 and it goes to 30, they do more. And when it goes to 35, they do more. At 40, they try their best to do more. At 50, they really try to do more. Most people can't do that. It's really quite amusing. When I got married 20 years ago, and my wife, the accountant, 1 + 2 = 3, unless you're talking to the IRS and you need it to be something else, we sat down the first year. And my wife said, this is very sad. You had a good year trading. You made a lot of money for us this year. That's wonderful. But Dennis, 55% of the ideas you came up with lost money. And then she said something that I thought was terribly harsh. She said, you can't even beat a coin toss. I said, sweetheart, just bear with me. I'm so in love with you, it's coloring my ability to think. She bought it, okay? But she said, you've got to do better. We sat down the second year. My wife, the accountant, 1 + 2 = 3. She said, this is really sad.
You did better this year trading for us than you did the previous year, but 6 out of 10 of the ideas that you came up with lost money. And don't give me that so in love with me crap. I thought she bought it. Apparently she didn't. Third year, my wife, the accountant, 1 + 2 = 3. She said, this is sad. She said, it's nice that you've made more money this year than you made the previous 2 years. It's a wonderful thing, but Dennis, 73 or 4% of the trades that you've put on, that you write about, that people pay to read what you have to say, 7 out of 10 of the trades lost money. You have got to get better. And I told her, I'm trying. I'm really trying. Fourth year, we sat down, my wife, the accountant. She said, I get it now. If you can just be wrong 95% of the time, we're going to get stinking rich. And I told her, I think I can do that. I think I have that case. I think I'm there. I think I can be wrong 95% of the time. The point being, what separates the pros from the amateurs, what separates the really good investors from the people who are mere pretenders, are the ones who will be wrong and understand they're going to be wrong and accept the fact that you are wrong, admit it openly, get out, and go do something else with the money. I love to tell the story. In 1974, sugar traded at $1.25 a pound. 1974. Inflation was raging around the world. We were convinced that there would not be a Cuban sugar crop again. The cane was going to be destroyed, hurricanes, whatever. There was never going to be another sugar crop, a sugar beet crop in North America. The sugar beet crop in France was going to be destroyed. It was inflation. The sugar crop everywhere was going away. Sugar has to go to $1.50. You had to buy some. You trade sugar futures. You bought some sugar futures. It went to $1.15. Well, you said to yourself, you know, it's $1.25 only a week ago. If I buy more at $1.15, if it just gets back to $1.20, I can break even, which is nice, till it went to $1. Well, at $1, you say to yourself, you know, I've got to buy it here because there's $1.25 only 3 weeks ago, and the fundamentals are still quite bullish. Everything I read tells me the sugar crop is going to be destroyed, and if I buy it at $1, if it just gets back to $1.12, I can break even, which is nice, till it went to 75 cents. Well, 75 cents, you got to buy sugar, don't you? It was $1.25 only 2 months ago, and the fundamentals are only beginning to change a little bit at this point. And if you just buy more of it at 75, if it gets back to 90, you can break even, which is nice, till it went to 50 cents a pound. Well, 50 cents a pound, you got to buy sugar, don't you? I know the fundamentals are now beginning to change, but if you just buy more of it at 50, if it gets back to 65 cents, you can break even, which is nice, till it went to $0.25. Well, at $0.25, you got to buy sugar, don't you? It was $1.25 only 7 months ago. And yes, by now the fundamentals are becoming somewhat bearish, but if it just gets back to 40 cents, I can break even, which is nice, till it went to $0.10. Well, at $0.10, you got to buy sugar, don't you? It was $1.25 only 18 months ago. And if you just buy it at $0.10, if it gets back to 20 cents, you can break even, which is nice, till it went to $0.05. Well, at $0.05, you got to buy sugar, don't you? I mean, honestly, because now the fundamentals are indeed overwhelmingly bearish. The Cuban sugar crop was, in fact, made. There are, in fact, sugar beets in Idaho, and there were sugar beets in France, and now there's a large crop, so there's a reason why. But if I buy it at $0.05, if it just gets back to 9 cents, I can break even, which is nice, till it went to 2 cents. And you know, at 2 cents, something really magical happened. Back in those days, you got to take delivery of sugar on the New York Coffee, Cocoa, and Sugar Exchange, and they gave it to you in 100-pound burlap sacks. People actually, honest to God, people actually took delivery of sugar on the New York Coffee, Cocoa, and Sugar Exchange, took a knife, cut the burlap open, dumped the sugar into the East River, and sold the burlap sack, which was nice until burlap became oversupplied. Now, that's just a good story of how far something can go once it starts to go down. You had every chance in the world to get out, and you didn't. I have no respect. I do not feel sorry even slightly for people who continued to do the wrong thing. People did the same thing in Enron, bought it all the way down, and then blamed it upon somebody else for their own mistakes. People did it, and I love to go to Canada and tell the story of sugar, because I tell them, you can take a chart of sugar from 1974 and 1975, put it on a wall, walk 25 feet away from it. Oh, and take a chart of Nortel, the largest telephone company in Canada, tack that on the wall. You can't tell the difference between the two, because once something starts down, you have no idea how far down can be. I've learned that collectively, we don't learn anything. That's really the most important lesson. I have learned that collectively, we do not learn anything. We see and do the exact same things time and time and time again. Would somebody please tell me the material difference between the housing bubble and the tech bubble? As I like to say, the character names change, but the plot lines are always exactly the same. We had bubbles in the 15th century, we had bubbles in the 16th century, we had bubbles in the 17th, 18th, and 19th century. We've had them in the 20th century. We've had 2 already in the 21st century. My bet is before I'm dead, and I'm hoping I have another 10 or 15 years, we'll see another bubble. I have no idea where it will come, but there will be one. It will get overextended, whatever it was, and people will blame their losses upon someone else. We never learn, and that's what I've learned. Let's talk about the economy, if I might, for just a few minutes and where we are. Clearly, this is a very serious recession. But folks, this is not a depression, and we're not going anywhere near one. What's important to understand is, I happen to be one of the few people who actually will say, I think Bernanke has done absolutely the right thing. Absolutely the right thing. He's the proper man to have at the helm in a circumstance that is economically degenerating. He wrote his doctoral dissertation on the Depression. He knows how egregiously stupid most administrators, most government officials, and many central bank authorities can be and were in the midst of recession. He knows, for example, that in 1931, now this takes the cake for economic stupidity. I give this one the award for all time. Understand that I'm somewhat to the right of Genghis Khan, so therefore when I take Republicans to task, it's very hard for me to do. But Lord, they were stupid in the Hoover administration. Because the Secretary of Treasury, Mr. Mellon, when stock prices are collapsing in 1929, suddenly became so afraid of the reliquefaction of the system that it would cause inflation. Now, stock prices had collapsed. And yes, people were in fact getting cash, much less cash than they had net worth a mere several months earlier. But Andrew Mellon was so concerned about rising inflation stemming from a reliquefaction of the banking system that he asked the Fed to tighten monetary policy, and he did something truly stupid when he said what we need to do is attempt to balance the budget because we're running a budget deficit here in 1929, 30, and 31, and we need to balance it. Utter and complete lunacy. Lunacy. At least Mr. Bernanke understands that last September and October, when the banking system truly was this close to seizing up, when 1 or 2 more days of disconcertion would have had a run on any number of banks around the United States, he understood the first obligation of a central bank is to make sure that there is more than adequate liquidity. Let's just firmly push, violently throw liquidity at the system. He was going to make certain that the banks did not contract. Now we're seeing a recession that has occurred. We shouldn't be surprised by this. The recession has obviously come about because of, I think, lunacy in the housing market. We all know the lunacy of the housing market. And the one good thing that's going to come of this, I think the best thing that's going to come of this, is finally Americans are going to understand, write this down, your house is not an investment. It is not an asset. It is not something you should hope to make money on. A house is a way to keep the rain off. That's what a house does. And if you wish to keep the rain off in a nicer fashion than the fellows down the street, that's your prerogative. But to think that you're going to make money on your house was lunacy. Such lunacy that any yahoo who could actually fog up a mirror was able to get a loan from some Yahoo bank, leverage that up, buy 2 more condominiums, leverage those up, buy 6 more condominiums, and think that this was going to continue ad infinitum. All you had to have was the first 5% correction in prices, and the one thing I have learned in 35 years of doing this is that prices do in fact correct in all things. It doesn't matter whether you're trading tomatoes, old galoshes, stocks, or houses, prices correct. And the first 5% correction on all these people levered up in manners that they should never have been allowed to be levered up. And to the best of my knowledge, not one of them had their hand pulled behind their back and forced to buy anything. I think, and I'm still waiting, I'll bet $10,000, I'll give it to the first person who can come and show me that his arm was pulled behind his back and he was forced to buy a house. I don't think anybody was, and nobody has taken me up on this yet. We got overextended, we got over-leveraged, and we believed that our house was an investment. This is the best thing that's going to come of this. We're finally going to understand that stocks are an investment. Raw land may be an investment. Commercial property may be an investment. Bonds may be an investment. Education may be an investment. But your house, it keeps the rain off. This is going to be a very good thing eventually. The problem that we have now is we still do have an oversupply of housing. How will we get rid of that oversupply of housing? I have some theories. We ought to do what the Canadians did several years ago. Canada was brilliant. Canada did a brilliant thing about 25 years ago. In the run-up to the takeover of Hong Kong, when all the Hong Kongers, who were members of the Commonwealth, when the Hong Kongers were very concerned that perhaps China might not be quite the pal that they wanted it to be, and they needed to make sure that they had another passport just in case, Canada said to all the Hong Kongers, got a deal for you. There'd been a little overbuilding here in Vancouver, a little overbuilding here in Toronto, a little overbuilding in Calgary. We got a deal for you. Buy a house. Actually, bring 400,000 Canadian dollars into Canada, keep it here permanently, give you a passport. They sold a lot of passports. They took care of an awful lot of excess housing in Vancouver. I thought it was brilliant. We ought to do the same thing here in the United States. We ought to say to people, you know, as I like to tell people, my old friend Brian Westbury has this great line. He said, never in the history of mankind has anybody risked their life on a raft to go to France. But people risk their lives to come to the United States. They do it all the time. And we try to turn these people back. We ought to say, bring $400,000 in, buy a house. Give you a visa. We'd sell a lot of them. We'd take care of an awful lot of oversupply of housing. Just a suggestion. Maybe we ought to give houses to our returning veterans. Maybe that's not such a bad idea. But we'll probably get rid of this housing oversupply. How will we do it? We're not building any anymore. Housing 2 years ago, in 2006, actually 2005, we were building 2.2 housing starts on an annualized basis. 2.2 million housing starts on an annualized basis. Now we're down to about 450,000 housing starts on an annualized basis. The oversupply will disappear very quickly at these numbers. High prices, as I always say, are the best fertilizer for a new crop, and low prices are obviously the best way to destroy a new crop. We're in a recession. We're going to see unemployment clearly get close to 10% again. It will not get anywhere close to what it was in the Great Recession of 73 and 74. I lived through the recession of 73, 74. I remember 12% unemployment. We're likely not going to get anywhere close to that. But please do remember that unemployment is a very lagging indicator. The Fed, by injecting reserves into the system last September and October, and yesterday making another concerted statement to put more reserves into the system, remember, it takes about 9 to 12 months for that liquidity to make its way into productive capacity. It usually finds its way first into stocks, then it finds its way into productive capacity. It takes 9 to 12 months to do that. If last September and October was when the first injections were done, it's reasonable to assume that it'll be September or so this year before we start to see economic circumstances begin to turn higher. And they will. They absolutely will. Unless all of the rules of money and banking have been rescinded, and I don't believe that they have thus far, by September we'll start to see the worst of the data. Please remember that the bottom of a recession, the start of an economic rebound, is when the news is absolutely its worst. So the news for the next several months is going to get demonstrably worse. Unemployment rates are going to get demonstrably higher. Housing starts will continue to go lower. Automobile sales will continue to wane. Fewer and fewer people will fly on airplanes. Traffic will get smaller and smaller. It will only take 9 minutes to get across Manhattan instead of 15, and 2 years ago it took 30. These things will all change. They always do. Economies ebb and economies flow. My fear is that we will try to do something truly stupid. My fear, and we are already talking about it at the government level, is that we are going to increase taxes on the most productive citizens in the country. The president, brilliant man, great rhetorician, wonderful understanding of the populist mindset of the day, is convinced that if he cuts taxes on 95% of the public, of which 55% pay no taxes, and raises the taxes on the top 1%, that we will go about our lives and pay no attention to them and write larger and larger checks. I can guarantee you one thing. The top 1% won't stand for it. They will find ways to circumvent it. We always have. We always shall. That's the harsh reality. And so then he'll have to raise taxes on the next 5%, and on the next 5%, and on the next 5%. What amuses me, and what I find interesting, is that the most capitalist regime in the world right now are the Chinese. They get it. They understand that if you cut taxes, you get more revenue. They understand that if you free markets, you get more activity. They understand that if you reduce bureaucracy, you get more stuff. I find it amusing that it's the Marxists who understand free markets better than anybody else does these days. What kind of a strange world do we live in where the communists get it right and the capitalists seem to be getting it wrong? I always like to tell the story when it comes to taxes. My favorite example of this was New Zealand back in the 1980s. New Zealand was a basket case in the 1980s. It was running budget deficits that were getting larger and larger every year. It was running imbalances of trade where its deficits were getting larger and larger every year. And the IMF would come in every year and say to the New Zealanders, in order to balance your budget, raise the marginal tax rate, and in order to increase export trade, devalue your currency. So New Zealand would do this because it was the IMF. Brilliant people, Nobel laureates in economics, telling them to do these things. And they did it for about 6 years. And every time they raised the marginal tax rate, they took in less revenue. And every time they devalued their currency, they exported less stuff. So finally, Roger Douglas, the new finance minister, took power and he said, this is what I'm going to do. Everything that the IMF has told us for the last 7 years has proven to be utterly and completely wrong. Don't come back here again. Please, IMF, leave. Now we're going to go the other way. We're going to take the marginal tax rate from 75%. 75% is what the New Zealanders were charging their own people at the margin, at the high end. And he cut it to 50. You know what happened? The first year he cut taxes from 75 to 50, the left went crazy. We'll take in less rates. Oh, my Lord, it'll be terrible. We'll have a bigger budget deficit. Took in more tax revenue. What did he do? He cut it to 40. You know what happened? Took in more tax revenue. He cut it to 30. The left was going crazy. You know what happened? Took in more tax revenue. He cut it to 25. You'll never guess what happened. Took in more tax revenue. Finally, after 6 years of doing this, he'd gotten the marginal tax rate down to 17%. And he passed the mantle of the finance ministry to Barbara Richardson. And I'll never forget what Mrs. Richardson in her first press conference said when she was asked. Now remember, the marginal tax rate has gone from 75% to 17%. And tax revenues have gone up almost parabolically. And she was asked, do you think you're going to cut taxes again next year? And she said, I'm not sure that I can, because I can't spend the money that I'm taking in now. You know what happened? She only stayed in for 2 years. The New Zealanders got complacent. Instead of having a Margaret Thatcher, Ronald Reagan type government, they brought back old labor. They brought back the left. The left raised taxes. Tax revenues went down. They raised the tax rate again. Tax revenues went down. They raised the tax revenues again. Tax revenues went down. My great fear for the country here in the United States is that we will raise taxes in an attempt, and we will say that we're doing it in order to balance the budget. Quite honestly, I could care less about balancing the budget. Quite honestly, if you look at the history of the last 25 years, as the deficit has gotten larger, interest rates have gone down. They tell you that if you have a large budget deficit, interest rates are going to go up, but the history of the last 25 years is simply quite the opposite. The economic circumstances of the past 25 years, except for the past year, are better and better and better every single year. We have more stuff than we ever had in our history. We are the richest nation the world has ever seen, and we've done it coextensive with an ever larger budget deficit. As long as we are the reserve currency of the world, as long as the dollar remains the currency in which all other global economic transactions are done, and who gets to be the reserve currency of the world? It's very clear. We took it over from the British when the British ceased to be the strongest military power in the world. The reserve currency status inures to the strongest military power. As long as we remain the strongest power in the world, we will continue to remain the reserve currency of the world. My fear is that we will try to give that away. If we do, then I shall begin to worry about budget deficits. Because if we can no longer sell our treasury securities in our own currency, then we have a problem. It's difficult to be Canada. It's difficult to be Australia. It's really difficult to be France. It's difficult to be any of the non-reserve currency countries. But when you are the reserve currency, when you're the strongest power in the world, when money seeks you out above all other circumstances, budget deficits don't mean all that much. That's a harsh reality, and that's the truth. The other thing that I like to see is that models have failed. I think we are about to see the ascendancy of the liberal arts major in economics for the first time in a long period of time. We have learned that econometricians, with their complex modeling of the last 3 years and casting that forward for the next 30, are simply wrong. Economies ebb and economies flow. Things rise, things fall. Bubbles go up and bubbles break. Models don't deal with those things very well. So if I think anything is really good to come of this, it's we are witnessing the end of the modeler. We are witnessing the end of houses as an investment. And we're going to see, mark my words on this, we have been taken to task in the United States because we are the worst savers in the world. We are now going to become the greatest savers in the world. The savings rate in the United States has gone from -1 to +3. It's probably going to go to +5. It's probably going to go to +8. Why? This is the last thing I'll talk about. The boomers are scared. I'm the ultimate boomer, born in August of 1950. Do the math. I'm getting old. All of my compatriots, everybody I know who is my age, probably has their kids gone. Their educations are paid for. Most of us didn't borrow all that much against our house, but everybody's 401k, as the new word is, has become a 201k. And everybody is saving money at a pace unmatched in American history. Ask the small banks. Ask them what their biggest problem is right now, and every small bank will tell you that their demand deposits are growing at a pace that they have never seen before. Demand deposits are checking accounts. Demand deposit growth is going rapidly higher because the boomers are socking money away. They're not going back to stocks. They're not putting it in bonds. They're saving cash. This is a good thing. This is a very good thing. As Mark Twain once said, the cat who sits upon a hot stove shall never sit upon a hot stove nor upon a cold one either, because they all look hot to him, and the baby boomer sat on the equity stove, and he's not about to sit on that stove again. So he's going to be saving money. We are going to be flush with cash in the United States in another several years. That's something to be optimistic about. So I stand in front of you and tell you, we are in a recession. These things shall pass. They always do. Unless we try to raise taxes, unless we try to balance the budget, unless we become more protectionist, unless the left becomes more ascendant, we'll get through this. 2 years from now, economic activity will have rebounded rather dramatically. The liquidity that the Fed has put into the system last September and October will make its way felt into the economy by October, November, and December of this year. The waxing of the economy will have ended. The strengthening of the economy will begin. Unemployment by early in 2010, having gotten close to 10%, will start to turn down, and the whole process will begin again. We don't learn, ever. We just don't learn. So that's my story, and I'm sticking with it. As my old friend Paul Tudor Jones, who's I think the greatest trader in the world, says, trading and investing is sort of like falling in love. You put your arms around that idea, and you hold it tight till she shows you the first sign of disrespect. Then you throw it overboard and disavow any association whatsoever. So I'm good at saying I was wrong. Remember, I'm trying to get to 95% wrong. I think I have that capability. Thanks for your time. Thanks for listening to my rant. And if there's questions, I guess that's what we're going to listen to, have a few questions to be asked, and I shall try to answer them. But first,
Good evening, everyone. I'm Todd Smalling, Park Scholar here at NC State, studying business finance, and graduating this spring to join J.P. Morgan in New York City in their trading division.
he's going to trade derivatives. It's cool.
We have a few questions from the audience for you, Mr. Gartman. The first question relates to financial stocks. Recently, we've had talks of reinstituting the uptick rule, of changing mark-to-market, and of bank CEOs talking about their earnings power.
Yeah.
Do you believe that stocks like Citigroup, which has obviously been beaten down, and the ETF FAST, which is a levered financial ETF, are good short-term or long-term investments?
Okay.
And that's the question.
Okay, first of all, let me answer the uptick rule. I am absolutely, utterly, and completely opposed to re-implementing the uptick rule. Utterly. Although I will grant an uptick. The uptick rule is I trade, I'm always long, I'm always short things. I'm always hedged. I tend to have long positions on and short positions on. And under the old rules of trading, you were not allowed to sell something short unless you got an uptick. It had to go up, and then you could sell it. And sometimes it was difficult to get an uptick. So they took the uptick rule out 2 years ago. I think it makes markets fairer. Because if you, for somebody like me who is always in all day, I'm buying, I'm selling, I'm selling, I'm buying, I'm buying, I'm selling, I'm selling, I'm buying, I'm adjusting positions to get my hedges right, I'm reducing options trades, I'm in all day long. And the fact that if you stop me from being there, you take liquidity out of the market. I create liquidity. I'm always there to do 1,000 of this, 2,000 of that, 10,000 of this, 5,000 of that. I create liquidity. If you institute the uptick rule, if you really think that the uptick rule sent stock prices down, I'll grant the uptick rule if you grant a downtick rule, that you're not allowed to buy anything unless there's a downtick. Then we'll make the market fair, and that'll be equal. So I'm utterly opposed to the uptick rule. Further, since I can trade futures, which do not have an uptick, to be able to trade without an uptick in futures and not in stocks is, I think, unfair and irrational. So I'm opposed to the uptick rule. Citibank. Camera's on. Don't buy it. Don't buy it. The only reason Citibank's going up right now is because there's an interesting squeeze going on in the hedge fund community between the preferred stock and a lot of my friends thought they had a free shot, and they all climbed into one trade, and now they're finding themselves having to clamor to get out. But if there's a bank that's in trouble, and Citi is one of my great clients, and they've been with me for a long time, but if there's one that's really got problems, it's Citibank. Do I think they'll be here 10 years from now? Sure. Do I wish to put my money at work in Citibank? Why? I'd rather buy Canadian banks where there are so many fewer problems with mortgages and CDOs and all the toxic assets that we hear so much about. I'd rather buy small regional banks. I'd rather buy BB&T. I'd rather buy Town Bank in Southern Virginia. I'd rather buy the People's Bank and Trust of Keokuk, Iowa, if there is such a thing. But why should I buy Citibank? Even Citi doesn't know what they have in their portfolio. Even management there doesn't know what they have in a portfolio. And my word, here's a bank that made as its chief executive officer a hedge fund manager that they paid $800 million to buy his hedge fund, and 3 months after he's there, the hedge fund went bankrupt. And this guy now runs Citibank? Are you kidding me? What? You can't make this stuff up. So, no, don't buy Citi. There are just so many others. I'm really quite bullish of the banking business at this point. The Fed, I think, is doing the right things. They're sponsoring a positive slope to the yield curve. One of the world's great powerful forces, maybe even more powerful than gravity, is a positive slope to the yield curve. And as I like to say, positively sloped yield curves can make geniuses out of banking idiots. It's just so powerful it can overcome even the dumbest decisions that can be made. And the Fed's sponsoring a very positive slope to the curve. So banks are going to do wonderfully. But buy the little ones. Buy the local guys who are just flush with demand deposits that they're paying 0% for. And they can buy 2-year governments at 125 basis points without any reserve requirements, and it's free money. It's a good business to be in now, but Citibank, I'd avoid it.
The next question.
I hope I was clear.
Very clear, thank you. The next question has to do with some of the monetary policy that you spoke to, a lot of the credit that the Fed has injected, and yesterday seeing quantitative easing come into effect. What's the best way for a retail investor to benefit from what is likely to become a weakening dollar or inflation in the future? Do you advise doing anything with a dollar play, or you've spoken to liking commodities? How do you advise a retail investor to gain exposure to a weakening dollar or a hurting treasury market?
Yesterday when the announcement was made, and I really didn't expect that the Fed would make that announcement yesterday. I knew it was coming. I knew the debate was ongoing. I figured that they would write in their post-meeting communique, I thought that they would say, we're actually considering this and it might be something that we're going to do in the future, put it actually on paper so that we could see it. I was a little surprised that they actually moved as quickly as they did. The instant that they did, I turned to Cameron and Chip, the two young men who helped me trade my account, and I said, let's go buy copper right now. My euphemistic comment is, I want to buy the things that if I drop them on my foot will hurt. Stuff. I want to own stuff. So I want to buy steel, and I want to buy copper, and I want to buy coal, and I want to buy railroads, real things. I don't understand tech. I just don't. It's way beyond me. I just went to the University of Akron and NC State. I didn't go to Harvard or Yale. They're much better equipped at that. They can lose lots more money over there much more quickly. Ask their endowment policy at Harvard how they feel about life now. It's beautiful. They had lost so much money. I just want to buy the things that I can understand. So I can understand copper in infrastructure and rebuilding, and I can understand steel and bridges and roads. And I can understand John Deere, and I can understand railroads moving stuff. And I can understand, but I can't understand pharma and I can't understand technology. So I'm buying in an inflationary environment, and what the Fed has done will, for at least psychologically, and perhaps for a period of time really, have an inflationary bent. And copper and those kind of things are going to do quite well. So I just said, buy us, get copper, get whatever, what copper stocks are we following? Freeport McMoran, go buy some, go buy 10,000 shares. So that's what we did, okay? Do I like gold? You know, I used to be bullish of gold, and I bought gold this morning. After I didn't buy it yesterday afternoon, I bought gold this morning. I don't like myself when I'm long of gold. I don't like most people who trade gold. I'm not a gold bug. I don't think the world's going to come to an end. I see most of the gold bugs, they all look like Ted Kaczynski, the mad bomber to me. Let's go get some gold and some distilled water, and let's get some ammunition, and let's go out to Lizard Lick, Those folks bother me. But in an inflating environment, you probably ought to own some. It's probably going to go higher. But do I feel comfortable doing that? If you're going to do it, one of the great changes that has occurred in the realm of investment in the past many years is that with the advent of exchange-traded funds, ETFs, you can make really clean and pure bets, for lack of a better term, on various markets. So you can buy GLD, which is gold, and it fluctuates precisely with the spot price of gold, rather than having to trade futures, which most of you don't like to do, and even I don't like to do, and I grew up in the futures pits, and I don't like trading futures all that much. With the advent of ETFs, I can make a bet on gold very easily. So yeah, in this environment, gold's probably going to go up, but am I going to like being long of it? No. Do I feel comfortable when I'm long of it? No. Do I like the people who trade it? Nah. Am I clear?
If markets are irrational, and if when things go down you should sell, if you should invest with the wind at your back, how can you predict the end of the recession? At present, shouldn't your strategies be based on a worsening recession?
What's interesting is stock prices start to go up long before history shows that stock prices go up before recessions end. They always do. It's called a capital market for a reason. It's because stock prices go up before economies make their lows, because the funds that have been injected by the monetary authorities find their way into equities first before they find their way into real productive capacity. That's just what happens. History shows that happening time and time and time again. Why do stock prices, which drives people crazy, why do stock prices go down before economic activity makes its peak? Well, because at the height of economic activity, money moves out of the capital markets and goes into productive capacity. It's drawn away from stocks and goes into labor. It's drawn away from stocks and goes into inventory. It's drawn away from stocks and goes into housing. So that's what happens at the peaks. That's why stocks lead on the way up. That's why stocks lead going on the way down. So what's interesting is, although the economic news is worse and worsening, stock prices made their lows back in October and haven't come anywhere close to making new lows. And one thing that good traders, good investors pay attention to is, how does the market respond to bearish news? When bearish news comes out and stocks don't go down, I as a trader say, I'm going to go buy some. Now I know where I'm wrong. Most importantly, know where you're wrong. Man, I hate losses. Boy, I hate losses. But what I really hate are big losses. Keep them small. Keep your losses really tiny. If you learn nothing else from me, learn that. Watch the great poker players. Great poker players are going to sit around a table. If they, when they get their first two cards, if they don't like their first two cards, they fold. They pay the ante and they fold. But when they get two good cards in the hole, they're going to bet the next series. And when they get three good cards, they're going to bet the next. That's what great poker players do. Think like a great poker player. When something goes against you, pay the ante, take your small loss, lick your wound, and come back and fight another day. Most of you won't do that. It's sad.
We have time for one final question, and that deals with diversification. There are some that say diversification is no longer a valid strategy due to what we've recently been through. Can you just comment on?
I agree. Diversification makes no sense any longer. All correlations in the modern world have gone to one. It used to be that you say, well, I can own stocks in the United States, I'll own some stocks in Canada, I'll own diversification because I'll own emerging markets. Back in the day, before communications was as viable and as vibrant and as real-time as it was, or as it is now, it was possible for emerging markets back in the 1960s and 70s for their stock markets to go up even while ours was going down. Nobody paid much attention to one another. But in the modern world, in the era of the internet, where news is 24/7 and it's instantaneous, the one thing that everybody needs to learn from last year is that all correlations have gone to 1. They all go up together, and they all, well, I shouldn't say all, my wife tells me don't say all, okay? Damn near all of them, okay, go up together and go down together. So diversification, if you think that by owning steel and pharma and some tech and some emerging markets that you're diversified, yeah, you just have a larger number of positions. But are you going to get any diversification out of that? Nah. The world's changed. The internet changed the world. It made us smaller, it made us one big place, and you can't escape the news any longer. So diversification, it's nonsense. The only thing that you can protect yourself nowadays is when you, honestly, the only way you can protect yourself, like I do. When something moves against me by 2%, I look up to the trading gods and say, I hear you. I got you. I'm going to get rid of some of this. When it moves against me by 3%, I say, I hear you. I hear you louder. I'm going to get rid of more of this. When something moves against me by 6 or 7%, I am gone. Gone. Because I want to live. To scratch out a living, I'm a grinder. I grind my 11 or 12% out of the market. I grind it out every day. 0.25%, 0.5%, 0.25%, 0.25%, lose a quarter, lose a quarter. I'm a grinder, but I want to be here next year. And what you have to remember, the game of investing is very simple. If you lose 50%, you've got to make 100% to get even. If you ever lose 80%, you need like 300% to get even. Don't lose money, or at least don't lose much money. And please don't buy something at 40 and buy more at 30 and buy more at 20. Somebody knows something you don't know. Don't play in their game. That's my story. I'm sticking with it.
Thank you.
Thank you.
Thank you very much. I'm just going to say thank you, and they're going to give you another round of applause.
Okay.
Dennis, it was great to have you back. Thank you for a very thoughtful and provocative presentation. Please join me in another round of applause.
Thank you.
And we'll see you back in the fall as the Millennium Seminar Series resumes. It's going to be an exciting fall. That's as much as I can say right now. Thank you all for being here tonight.